Welcome to the CoreLogic Economic Outlook for June 2016. Single-family mortgage default rates have fallen sharply over the last few years, and finally this year have retreated to levels last seen prior to the Great Recession. Measuring default by the percent of loans that are seriously delinquent, defined as loans that are at least 3 months delinquent or are in foreclosure proceedings, CoreLogic has reported that 3.1% of loans were seriously delinquent in March, the lowest level since November 2007. The seriously delinquent rate is likely to decline further and could reach 2.5% by the end of this year. Well, that's good news. Even that rate is very high relative to history. It will likely be 2 more years before this default metric reaches a normal level. The seriously delinquent rate was below 2% for most of the period since the 1950s until the Great Recession. During the recession, the unemployment rate spiked and remained above 8% for more than 4 years, the longest time span with very high unemployment since the 1930s. Coupling that with a severe and widespread drop in home values added to the looming foreclosure crisis. The CoreLogic Home Price Index for the nation fell 32% from its 2006 peak to its trough, and some metropolitan areas had price declines that were double the national drop. The default rate has fallen from its 2009 peak, as job and income growth have helped to repair family balance sheets. Home price growth has restored home equity for many owners. Loan modifications have altered loan payments to enable borrowers to stay current, and foreclosure completions have eliminated debt. Unfortunately, foreclosures will continue to occur as job loss, illness, and home value declines will affect some borrowers. During the first 3 months of 2016, about 70% of loans that began foreclosure proceedings were originated prior to 2009. Even though these loans account for only 30% of loans currently outstanding. Careful underwriting and economic growth can lessen the likelihood of default, but not eliminate it. By comparing the serious delinquency rate by origination vintage, the effects of too lenient underwriting and a recession are clear. Loans originated from 2005 through 2008 had very high default rates during their first 5 years, with the 2006 vintage the worst. For 2006, the serious delinquent rate hit 20% for loans that were outstanding after 5 years. In contrast, loans originated since 2009 have performed very well, with default rates even lower than the 1999 to 2003 vintages. Thanks for your time. For more on CoreLogic's perspective on the U.S. housing economy, please visit the Insights area of CoreLogic.com.